Hey everybody, it's Brian Shannon from AlphaTrends.net. Today's Friday, the 29th of April, 2016. We closed up the month for the S&P 500 with a gain of just 0.4%. NASDAQ, however, was down 3.2% and largely influenced by the weakness in the semiconductors, which had a real bad day today, down 2.5%. But oil is positive year to date, and we have a lot of mixed messages in this market still. So let's take a look at the charts and make some sense of it at this point. The daily chart of the S&P 500, you can see that since we've begun this rally, that we have been holding above the rising 10 and 20-day moving averages. And today we closed below that 20-day moving average. What makes this different than these little closes over here for below that moving average, or that the fact that we broke important support level today. So as I pointed out on Twitter on Thursday evening, what I was hoping that we could see today was that we could see a little bit of a rally and then look to short it. Unfortunately, that plan of action didn't materialize as we had the market open a little bit lower here today. And if we take a look at just today's action right here, it stayed below that volume weighted average price for almost the entire session until the end of the day, where it did get back above it. But for the week, we obviously had a negative performance for the market, and these are our 5 days for this week. So obviously we're lower, and we are below a declining 5-day moving average. So next week we're going to be looking at this market with an eye of suspicion, as we are below this 207 to 207 and a half level. As long as we remain below that, then I think the intermediate term trend, we're still going to look at that as guilty till proven innocent, and perhaps we bleed off down even as far as down to the 50-day moving average, where this prior support level was found. The NASDAQ, for its case, did break below and hold below that 50-day moving average. So as I often say, we don't want to be the people who buy at the 50-day moving average. That was right here at about 107.13. Instead, what we want to do is we want to look at the action on a shorter term time frame and see if in fact it makes sense to buy there. Now, if you bought there for a day trade, let's say above this level, then you had to be aware, as we pointed out in Alpha Trends, that we were suspicious of the market as it was still below this prior support and this declining 5-day moving average. And sure enough, it failed to hold. And once it got back below that 2-day volume weighted average price, the floodgates really opened. So going into next week, we've got this market that's sold off pretty hard this week, but one potential level of interest that might look pretty far away, down at about 103.90, is the year-to-date volume weighted average price in the NASDAQ. And I think it's possible that we get there. We certainly have a lot of damage done to individual components in the NASDAQ, and we'll talk about those in a moment. But for now, we are still below a declining 5-day moving average with lower highs and lower lows. So there's no reason to be a buyer. It's just a guessing game if you're being a buyer in here. There's plenty of time to get involved on the way back up when the market tells us that that's appropriate. The Russell 2000, and what we were looking at here as early as Wednesday was the possibility of, from a failed breakout, might come a fast move lower. Now, the Russell has been stronger recently, and it's been finding support at that rising 20-day moving average as well. And here we are right to it once again, and it's come down right to also, of course, this prior little area of support. So when we look at a shorter term time frame, such as the 30-minute time frame, we have the potential for some rally, bounce in here. I think that if you look at it, and next week, if we see a rally up towards this 113-ish level, then you would want to monitor it for a possible short sale with a stop just above whatever this most recent relevant lower high might end up being, if it sets up this way. If it does set up that way, well, then where does it have the potential to go? Probably down towards 110 and near that rising 50-day moving average. The semiconductors, as we said, were one of the bigger losers this week and this month, and they finally broke down through the bottom end of this range. So as I mentioned to subscribers, I don't like to try to buy a perceived level of support, because when they fail to hold, if you're not not out quickly, which maybe you do that, then it can be pretty brutal. Like the action in these semiconductors the last 2 days has been pretty brutal here, and obviously we've broken a key level of support in here. The this market, I would say the first level of potential support next week, right down about $52 a share. I would be looking for, looking at retracements in here and saying that, let's say, for instance, if we, this is the recent event, I would think that a 61.8% retracement, if it got us up here, that would certainly be in an area where it might have the opportunity to sell off once again. So, it's sold off pretty quickly, pretty hard here, and potentially, going to stabilize near 52. But the fact is, in the intermediate term, it's a broken market, and if you're trading the long side here, be highly suspicious of rallies and be ready to exit them quickly with a profit rather than let the market take them away from you before they may continue back down again. My personal preference is that if I'm going to day trade, if I'm going to take a trade in a broken market like this, it would only be for a day trade because it simply exposes too much risk in the direction of the primary trend. And that we think of the phrase from failed moves come fast moves, like the Russell 2000. But also, when we look at these semiconductors, we have to look at it and with an eye of suspicion that this will in fact become a potential level of resistance. The biotechs were a budding turnaround. It appeared a couple weeks ago, and I was certainly looking to get bullish on them again this week. What we didn't see was a higher high above the rising 5-day moving average at this point. It failed to get back above there, and we had failed the 5-day moving average, and then this volume weighted average price for the year. We are now back below that. That's the purple line once again. And by the way, the link to these charts is in the email if you're interested in using them. But if you sign up for them, then I can send you this exact page that I use as well. Anyways, on the IBB, we're down to the 50-day moving average. So we've seen 6 days down in a row in the biotechs. I certainly wouldn't want to be shorting them here. So you have to look at it and say it's too late to short this market, and we're in a potential level of support. It's probably just in a void here with really not much opportunity unless you're just scalping. Shares of Apple continued lower, and last week we had spoken about there was still there was no reason to be involved in this stock as it had broken below that key near-term level at 108, that it had made a lower high and lower low and had a declining 5-day moving average to stay away from stocks that do that, and it's continuing down. In looking at the longer-term trend, it's still it's got this pattern here where we have this high, the lower high, and then the lower high. The stock was added to the Dow Jones March of 2015, and it's only traded closed above that price where it was added on 27 occasions. It's down more than 25% from the addition to the Dow as well. So a clear pattern here of lower highs, more support tests of this support, I think would stand to weaken it and possibly continue lower. Now, from here, I don't think it's a good short sale, not after just dropping from 112 straight down to 93. It seems as though it's in a potential level of support, but what would be better would be a little shakeout perhaps down below this low before a turnaround might occur. And we spoke about this week the possibility of a shakeout below the 50-day moving average, and then earnings might be able to turn it higher. Obviously, the earnings were not enough of a catalyst, and this is why you don't buy broken stocks. This is why you don't buy stocks that are making lower highs and lower lows below a declining 5-day moving average. The TLT is still struggling to find support near that year-to-date volume-weighted average price, and this level we had identified last week as support still looks valid. It is making, it does have a downward downward slope to it. So perhaps these bonds rally up and then break back down. But for now, they are still holding up above a key level of prior resistance, and the longer term trend is still higher with a rising 20, 30, and 40-week moving average. So I wouldn't panic on bonds, but certainly if you're long bonds, I would say that a stop would likely go underneath these recent lows in here. Amazon was the big winner this week from earnings, but as was Facebook, obviously. So those two, Facebook closing at all-time highs here right now. It's never closed higher on a weekly basis or even on a daily basis with today's gain. So we've got trends that you have to look at each trade based on its own merits. And stock like Google that they gap down on a bad response to earnings. They are not bargains when they do that. Not while they're still below a declining 5-day moving average. In January, I had done a webinar about the about avoiding losers in 2016, and I think it's a very good time to review that once again, because stocks like Netflix, even a lot of people use Netflix, love the company, etc. But when the stock gaps down and then continues to bleed off, it's telling you that there are big institutions changing their mind about how much stock they should hold, and they're selling it. By the way, I am out of PayPal. I've mentioned that one numerous times here. I expect that going to continue to monitor this stock for a potential purchase opportunity. But they reported earnings on Thursday. The stock gapped up, and then it failed completely, stayed below the volume weighted average price almost the entire day on Thursday. So if we take a closer look, let's say at a 5-minute chart here, I can put that volume weighted average price right from where it gapped up, and you can see that it had found resistance then at that level and continued to bleed off. So for me, there's no reason to continue to hold this one long. I still think the idea is one that has potential, but during times of uncertainty like we have right now in the stock, where it's selling off on so-called good news, you can have a huge short position in there, but they apparently aren't panicking right now. So I think the safety of cash is better while you wait for a stock like this one to reset up and present a low risk opportunity to purchase it. And right now is not the time for that.